Hey guys, it's Marcin, Drozdz, and I'm here with Ken McElroy of MC Companies. Ken McElroy is somebody who I've followed for just over 20 years. You're literally the guy that got me into multifamily way back when in the business. The saying of the bigger the brochure, the bigger the BS is from yours truly
Yes,
and Mr. Kiyosaki. And for those of you who haven't met Ken McElroy yet, his company MC Companies, they have over 10,000 doors at this point. They operate in multiple states, and that equals to roughly about $2 billion in assets. So, Ken, first of all, thank you for
yeah,
welcoming me
of
in your
course, man.
studio.
Yeah.
This is fantastic. Really excited. For those of you who haven't met me before, I'm from Toronto, Canada, and I've been investing in US multifamily for, like I said, nearly 20 years. And the first deal I actually invested in was your deal, which was Sun City.
Which we still own.
Which is you still
Yeah.
own, exactly. So appreciate you taking the time. The first question I have a whole bunch of questions that I want to ask you. But the first question is, I remember you telling me that you started this business from the ground up in property management. So did you, or how did you determine like that line in the sand from just being an employee to actually taking the risk yourself? Like how did you get into that?
Well, I think it helps when you're young.
Yeah.
You don't know any better, right? Like it's the truth, kind of. I mean, I was fresh out of school.
Yeah.
I was managing property for free rent, essentially, while I was in school and then after. And a friend of mine said, why don't you get your real estate license? And at that point, I was trying to figure out what I wanted to be and who I wanted to work for and all that kind of stuff. And I enjoyed running properties, actually, because I had done it before I graduated. And the guy offered me a position, and I said, sure, I'll take it. And all of a sudden, here I was in property management, working for a company out of Seattle, which is where I'm from. And then that company grew a lot. And so that was a gift because that company started growing. And then, of course, opportunities started growing from there. But really what hit me the most was I remember being in the property one day, and I had grown up working in construction with my father, and my mom was a hairdresser. My dad was in construction. And so I knew how to fix everything, clean everything, and we just never ever had a maintenance person or any kind of a company ever come into my home ever. Like it just was.
You were the maintenance guy.
Yeah, my dad was, and then I of course learned with him. Right, I was always helping him. So I grew up that way, painting, doing everything. And anyway, so when I got to the property. I just did all that stuff. I was like, well, of course, like this place needs cleaned up.
As the property manager, you were just doing it.
I was like, yeah, well, I'm just doing what I thought I needed to do. So I was like painting units and cleaning units and fixing toilets and repairing plumbing. And
they must have loved you.
Well, I didn't know any better at the time, So anyway, the owner came in one day and he's like, man, I want to thank you very much. I go, why? He's like, well. He goes, the occupancy is high and the expenses are low. And I'm like, well, yeah.
Yeah, I'm doing everything.
Right. Of course it is. I had no perspective. I really had no idea.
Right.
And I'm like, man, he goes, well, you've really grown the value of this property and for me, there were some problem people in there that weren't paying rent and there were some vacancies. And I was it's a common sense business. I was like, well, okay, a full property with good people that pay rent, that requires less of my time. Right. And so I learned that way. And so by the time I got my license and I started managing more properties, I just kept that bar the same. So I was always trying to just be super efficient at the way I was running properties. And I didn't want the properties to control my time. And I knew that there were things that you could do. And so that I really was blessed by being able to be on site and learn all of those things. So then when I got to scale it with more and more properties, that's the first step I did. And so it took me though, however, 6-7 years of managing properties before I actually bought anything. So I was in the property management business right out of college. So, call it my mid to late 20s. Okay. And then that's when I was like, okay, it's now time to own these. And that's what I.
So what was that like? Was there like a light switch moment where you realized how much value you were adding?
Yes. So what happens is as a property manager, let's say you buy something.
Yeah.
And obviously you live in Canada, you're buying in the US, you need somebody local to handle The operations.
100%.
Okay, those people are valuable,
Oh,
as you know, right?
yeah.
So one, I started to learn the value of property management, but two, I started to realize that there are guys like you that were
Hmm.
buying properties that needed guys like me.
Hmm.
And I'm like, well, why can't I be like you, right?
Right.
And that was really it. I was like, why can't I be the guy that's buying these properties? Because what I was doing was I was managing properties like let's say you bought something that's 50% vacant,
Hmm.
and then you rely on a guy like me to fill it up.
Hmm.
Okay, so I was creating value for you,
Hmm.
and I was like, man, I should be able to do that for myself. So that was it for me. When I got to at some point, it took me a while, unfortunately, but at some point I was like, man, I can create that value. I can just do it for myself.
Huh. So the first couple of deals you did you manage to do them on your own? Did you start raising like how did
The very
you?
first ones were, of course, like everyone,
Yeah.
I thought I needed a bunch of money in
Right.
order to start, which of course is not the truth.
Right.
I used my own, and then I was out of money.
Yeah.
So then I had to learn how to raise money, and then I realized at some point that there's more investors than deals.
Mm.
So once I started finding, as a property management industry, you're used to taking over problems, and
Yes.
so it's probably better to buy problems
Hmm.
and fix them than it is to buy properties that don't have any problems. So that's kind of what I focused on, and I realized that I if I'm going to scale this, I'm going to have to find people with money. So
Hmm.
that was my next step. I didn't know how to do that. I didn't know how to buy them. I didn't know how to find people with money. I didn't know how to manage them.
Well, and I call it I call it your unfair advantage. Is for you, it was clearly the operations side, which most guys do backwards because they think they're going to go raise the money first,
Right.
and then they try to find a deal. But if they don't appreciate what you appreciate, then
Yeah.
those are the deals you end up
Yeah.
picking up after.
I'll tell you
Potentially.
the other thing that you're 100% right there. But then what I really realized was my kryptonite, I guess, was I actually, when I got a deal presented to me, I could see, oh, no. I got to pass on this one. This one's already fully baked. Like in other words, I could see through the broker's BS. I could see through a syndicator's BS.
Brokers never lie.
I know. But I was, it's funny. So not only did the property, because remember, as a property management company or an individual,
Yeah.
you would bring me an asset, and then you would fly back to Toronto,
Mm-hmm.
right? And then you'd call me every once in a while. How's it going, right? So I had years of doing that, and
Right.
so at this point, I do know, like, can I move the needle on this or not? And so when I'm looking at deal flow, I'm like, okay, this one here, it doesn't make sense. The math doesn't make sense.
Right.
Because, so you always move to the end. Like, can you create value in this asset or not? And so it gave me this, I guess, I had the wisdom at that point, although a lot less then, that I knew I could buy this asset, and I knew exactly how I was going to fix it because of my property management background. So I never got into bad deals. I never had to rely on the market
To save you.
Yeah, because I knew. So in other words, I was using the experience I had from property management. I was evaluating the deal that way, and I was like, yeah, I can do this. And here's how I would do it. And so we were buying properties before I purchased anything. I already knew the outcome.
So when did you actually go from being a fantastic real estate investor to a business owner?
Yeah,
Because you're 2 billion now.
Yeah.
You're not just a real estate investor.
Yeah. I know. It's hard for me to believe,
like
actually.
it's like 10,000
Yeah,
residents, right?
it is.
So
It's funny. I never sought out to hit those numbers. I feel like my whole life I've just been hitting singles.
right.
Just trying to buy one deal at a time correctly
Mm-hmm.
that cash flows
Yeah.
and has some kind of a value add to it. It's the same model every time.
Yeah.
It's, we're not swinging for the fence ever. We try to find stuff that's broken and fix it. And that could be from a lender. It could be from a broker. It could be from a seller. It doesn't really matter. And so to answer your question, you start off, a little confused about all of it, right? You're just trying to not lose investor money,
Yeah.
and you're trying to cash flow, and you're trying to. I mean, I remember the first deals I hired, her name was Sandy Smith. I still remember. She was my receptionist, my secretary, my accountant.
That were your first few staff.
My first staff.
She was your first.
Yeah. And I don't know how I convinced her to work for me, but it was just me and her. And then so at that point, when you take one person on,
Right.
I'm just concerned about making sure that she can feed her kids, right?
Yeah.
Like so every time you grow, it went from me being self-sufficient and having income to then transferring it to Sandy and making
Right.
sure that I can now make 2x, right, just to cover me and then her. And then so each time you grow, it's a stretch.
Mm-hmm.
And so all of those things were part of the growth. I think it's a natural progression. Now, of course, 300, I guess we're about 300 people now. It's you learn a lot. So I first went from being financially free personally to my company being financially free.
Right.
And then that's pretty cool. When you get to a point where you have so many assets that are paying management fees that are covering all the overhead for
Right.
our whole company.
And that's such an important distinction to make, because there's so many people, I see it, you probably see it, where they're out chasing deals because they have to get a deal. Like they have to do a deal to pay the overhead. And I think what you're saying is your business with the fees, with the existing cash flows, with what it is, like if there's no good deals, you don't have to do anything.
Right.
And that's that freedom at a business level that you're talking about.
Correct. Right.
Yeah.
And so I always had the property management, piece. So I could always just make sure that the properties were doing well.
Mm-hmm.
And, so I started the company with just the property management fee income.
Right.
And then you kind of move it into complete ownership. And then, of course, the cash flow side of it. So you have both, So we have cash flow out of the properties. And then we have the management company that gets a fee.
Right.
If we're doing a good job.
Yeah.
And then that actually supports that company as well. So then you start to build, those individual businesses.
Yeah. And when you started the business, did you originally name it MC Companies, or is there a story behind that too?
So there's a bunch of stories.
Whichever one you want to tell me.
Yeah. There's so many. Oh my gosh, there's so many. Let's see. The first company I started was McElroy Management, which is my name.
Right.
And then I grew that. And then I was involved at a multi-housing conference.
Right.
And I met my current partner, Ross McAllister. We've been together now 23 years, I think. So he was doing the same thing under McAllister Company.
Right.
And then we joined and we called it MC. So he's McAllister, I'm McElroy. So it seemed like the easy name at the time. But there's been so many before, back in my 20s and early 30s. I've done a number of things. I think all in, we have over 100 businesses, probably.
Is that right?
Yeah.
Wow.
All inside of this company.
So when you say 100 businesses, you mean like all the ancillary or supportive companies?
Different ones.
For the bigger...
Yeah. Just like in the property management business. We've got a utility company, we've got a collection company. Yeah. So you've got different things. We've got different folks doing different pieces.
So when some people say they're vertically integrated, you're like legitimately vertically integrated.
Yeah. And obviously we're a developer, we're a contractor,
right.
And then we have different things inside of those. Obviously what we're doing here is a company, the KenMcElroy.com, that's a company.
Right.
And then inside of there, we have a few different businesses. I've got the Mastermind, and then we've got Limitless, and so there's a whole bunch of things that I've got my hands involved, and it's all vertically integrated.
So when you partnered with Ross, because I remember in previous interviews you mentioned that Ross, if I remember correctly, had the investment banking background or the banking background.
Mm-hmm.
He really understood, the construction side. You understood your side. This is really important as much for me as anyone else. Like, you guys have been in business as partners for over 2 decades.
Yeah.
That's incredibly rare. Like, I've heard people say partnerships are like sinking ships, right? So, so it's, and for you guys have stayed together. So can you expand a little bit on how
Yeah.
you've managed to do that?
I
Because
think it's
that's
probably a little bit of luck, but it's also not. Like,
right.
there is life changes people, life change, things, life situations can change partnerships a lot. But in
Hmm.
my particular case, I had the property management side, the
Yeah.
operation side, and Ross had the construction and the
Okay.
finance side. He was one of the youngest presidents of a savings and loan back in the day. I'm talking about in his 20s.
Oh wow.
And so, he'd been on the underwriting side, the credit side of a bank,
Mm.
and also had a general contractor's license. And I had the ops. So for that was pretty easy. We said, listen, let's just stay in our own lane and start buying assets. And that's what we did.
Well, what are some of the intangibles on a personal level? Like, how did you know that you guys could work together aside from, because the resume checks out, that's
Yeah,
amazing. But
yeah.
were there some indicators on a personal level
Yeah,
that you're like,
I think a bunch. You can tell a lot from a partner with their personal life.
right,
Ross
fair
and
enough.
Patty. Today's her birthday, actually.
Oh wow.
They've been married since high school. They've got a number of kids. They're close with them all. They're all part of the business. You can just tell.
Mm.
There are signs, or women see it more than men. There's red flags that. In fact, I remember when we first got together, Ross is like, "Well, you gotta go through Patty," 100%.
That's
Yeah, oh
awesome.
yeah. So we had breakfast or lunch or something with Patty, and she was thumbs up or thumbs down. So, there are things that, yeah, they're all there. We just
Yeah,
choose not to see them,
yeah,
And so for us, I think the number one thing was our investor,
yeah.
always. So investors first, us second. So if we could pay back our investors, we'll do fine.
Hmm.
Not everyone thinks that way.
Yeah.
But that's a very easy thing to figure out.
Yeah. Well, you can look, I mean, almost 3 decades in the business, who's come and gone in
Yeah.
that period of time, I
Right.
think speaks
Yeah.
more than anything else.
Yeah. Like people are going through it right now,
Yeah.
right? Like the market has tanked.
Yeah.
Values are down.
Yeah.
We were on the phone today with our investment committee talking about this exact thing. We bought properties 2-3 years ago that aren't worth what we thought they were going to be 2-3 years later.
Yeah.
So it's, how do you communicate to the investor? What do you do? What do you do as a partner? What do you
Yeah.
do as a general partner? How do you handle that? How do you communicate with those folks? They're not in trouble, but the point is, the values are down today. So how are you capitalized well? Are you raising money? If you are, how's that working?
Right.
Are you squeezing down the LPs? Are
Yeah.
you bringing in extra partners? Like, what's your strategy?
Yeah. Well, and I think what Ken's saying, for those of you who are wondering, squeezing down the LPs, what's happening now is a lot of people are actually going out and raising additional equity, but preferred equity, and they're putting that in front of the LPs, and it creates a different dynamic. And it's so funny that you say that, because I've literally been getting phone calls in last 2 weeks from people in my network. Hey, there's this portfolio of
Yeah.
1,000 doors. Hey, there's this 2,000 door portfolio. There's this. Banks are figuring out, they're like, and I'm sure you guys are getting those phone calls
We
all
are.
across the board.
Yeah, and so I guess there, in every deal, there's what we call a capital stack.
Yeah.
Right. So typically there's your debt, and then there's your equity, but there's different kinds of equity.
Yes.
So if you just raise money with debt and equity, and you buy something, and then it gets in trouble, you bring in another piece, which is called preferred equity, in between the debt and the equity. So that pushes the original equity down below it. So that puts them in a more precarious situation. And,
Yeah.
and so that's what we're talking about
Yeah.
and so the question would be, are those general partners or all those sponsors communicating that correctly?
I can tell you that a lot of LPs have no clue.
Right.
They think that because the price is not marked to market, so you don't actually know what your units are worth.
That's right.
And the brochure still says 100 grand, so they
Right.
think they're
Yeah, and right. So that's all happening now,
Yeah.
right? So what's happening? The bow's starting to break, right?
Mhm.
And when that happens, the pieces fall on the floor, and there's guys like you and guys like me that come in and solve the problem,
Yeah.
and unfortunately in a lot of cases the original equity are the losers.
Yeah. So just like a billion questions I want to ask you to follow up on that one, but I'll ask the most timely ones. So when you get calls from the bank, I've heard you say before that sometimes even taking over the bank's position isn't worthwhile.
Yeah, that's happening now.
That was my follow up.
Yeah, oh yeah. And so, well, that's actually what the preferred equity has to be careful of. So
Right.
using that exact same
Catching a
example,
falling knife as well, right?
yeah.
So
You might have a deal right now that is not worth the loan,
right.
and so
And if you guys think about that, so if somebody bought a 30 million or a $50 million asset and today it's worth half, that bank is taking a haircut along with the equity.
yeah, if they have to sell or something like
Right.
that, yeah. So probably the best example is an office building,
Right.
with the work from home stuff.
Yeah.
Okay, so if you bought an office building, or I've owned several. We just sold our last one in July of last year. Well, when you buy it, it's 90, 95, even 100% occupied.
Mhm.
Well, now the work from home has kind of changed that
Yeah.
for a lot of folks. So let's say the occupancy goes to 50%. That
Yeah.
means you have 50% of the revenue,
Yeah.
50% vacancy with the same expenses. So that means that the property is not worth the loan. And
Yeah.
so these are the scenarios that people are investors in
Yeah.
a lot all over the place. And it's not really a big deal unless you have to sell,
Hmm.
right? And then it becomes a big deal.
Yeah. Well, we were chatting earlier. Literally, one of the first opportunities I did is we were buying medical plazas right here in Arizona, and they were half empty. So we only had to pay for half of the cash flow
Yeah.
on the asset. Now, the kicker was there was no financing back then, 2011, 2012. So you had to pay cash.
Yep.
Right. But because it was half empty, you paid for half. And
Yeah.
and that's what you're effectively saying.
And that's where we are now. Like those days are coming again.
Is that right?
Yeah. It's
You look
awesome.
excited.
Oh my
I'm not
gosh.
sure.
Well, I mean,
It's tempered optimism,
yeah,
right?
like, has anybody really learned anything in the last 10 years?
No.
Yeah. So this is the time. This is a time when we'll see.
So Ken, for those watching or listening, they're like, look, it's easy for Ken. He's already doing all these things. Raising money might be easier today than it's ever been before. But and there's a whole story behind that, I'm sure. But walk us back to when you first started raising capital. Like how did you build the confidence with investors, and how did you get people to want to back you when you were still
It's a good question.
growing into things?
So I think a lot of times, like just going back to my original days as a property manager, I believed that I had to have all this money
Right.
to be credible and to be in the game and all that. And then I quickly realized that it's really the asset, right? The asset pays everyone. So if you buy it correctly, everyone gets paid.
Mm.
So what I did is I just always made the asset the hero.
Mm.
I never had to sell myself. Now you have to have the team to be able to pull it all off.
Right.
So yes, you have to have all that in place, and it doesn't necessarily have to be paid. They could be consultants. They can be aggregated together. But the point is that the deal always pays everyone.
Mm-hmm.
So if you're buying like with your medical office buildings,
Mm-hmm.
pretty common sense. If you buy something that's 50% occupied and you get a deep discount and you make it 100% occupied, it's going to be worth more.
Right.
So pretty common sense. So when you tell somebody, I always tell everybody, like, if you buy a vacant building, it's going to be worth a lot less than if it's full.
Mm-hmm.
So if you can just make it full, then now you're not really selling yourself, or you're just kind of selling the value add. And so the real focus of the entire sales process is really based on the plan to create value.
Well, and to you, it's such a natural progress because as a property manager, that's what you did to start. And if I was to build upon what you just said, the deal does the sale, but identifying the deal and being able to
Yeah,
shine the light on it,
that's the hard
right?
part. Yeah,
Because how many people want to sell for future earnings or whatever it is,
correct.
right? So,
Yes.
so that's the big piece.
Yeah, yeah. You build that network,
Yeah,
obviously, of deal flow into
yeah,
you, and even identifying things that maybe aren't for sale, and then you start to become, the turnaround guy,
yeah,
and I also if you position the equity or the investor in front of yourself,
mm-hmm,
it puts a lot of pressure on you
mm-hmm,
because okay, you got to pay everyone back before I get paid.
yeah,
So the last thing I want to do is work for years
yeah.
for nothing.
Well, and maybe you want to answer or you don't, but have you ever done a deal where you're like, oh, I'm totally going to work for free on this one
Oh
for the
yeah,
next year or
yeah,
two?
yeah. Not a lot, but
Well, it
yes, the
happens.
condo conversion days.
Oh, is that right?
Yeah. Oh, man. Well, I actually did really well on about 2,500 units, and then those last ones, man. We barely got out with our, I mean, I lost a bunch of money at that point.
Mm,
We had done a bunch of done a bunch of work on several of them. I think that was what, '08, maybe '09, something like that. When all the investor loan stuff closed
yeah,
back,
yeah, yeah.
and and people couldn't buy investors deals anymore. I had a bunch. I was hanging out there in Vegas, Scottsdale, and Tucson,
Were you just sitting on them? They're
just sitting on
vacant.
inventory. Yeah, yeah. I mean, we're in the
Oh,
middle of deals, and then so
oh, because the
yeah,
financing drive you're talking about right during that.
yeah,
Okay.
yeah. So those are the ones that you know I lost some money during that period, but
And was that the transition point to then the buy and hold refinance
yeah,
strategy,
I
or?
was like, gosh, I just worked my butt off for years on those these projects, and they had huge paydays at the end, right?
Yeah.
But then I was like, well, I think I'm just gonna buy these things and get this do the
Yeah.
passive income, because one was a capital. It's like a big flip.
Yeah.
When you buy a 200 or 300 unit apartment building, like we did one in Portland, Oregon, it's 300 units. You sell it off piece by piece. Buy it for 100, sell it for 200, let's say. Massive profit.
Mm-hmm.
But then at the end, you've just basically done a big flip,
Yeah.
and then you got to go do it again. So that caught up to me, and I was like, man, I'm not gonna do that again. I'm gonna start keeping these properties and cash flowing like crazy.
So how did you? Because because it sounds great and everybody says, yeah, cash flow, long term refinance, but the fact is that when you do that, short of you buying an incredible discount, you have a waiting period, right, where you have to be able to increase the
Yeah.
value and do the refinance. So did you? How are you able to communicate that messaging to potential investors? Because that's not as sexy, quote unquote, as hey, we're going to buy this thing and flip
Yeah.
it, and in 12 months we're all going to be rich.
Yeah. So I think what makes our company different is I don't actually hang my hat on the refinance cash out at all,
Okay,
ever. I don't. I actually tell them these are long term holds,
got it.
and so the reason I do that is one, I want to, again, going back to my condo days.
Right.
Like I said, man, I started with a guy out of Canada, International Property Group out of Edmonton. Phil Carroll was his name,
Okay.
and Dave Steele, and they did a lot of condo conversions up there. Was another group was a Boardwalk, I think.
Okay.
Big companies out of Canada, and we came down and we started doing those. But what happened is that was a strategy. That's a invest money, turn it, make more money. Invest
Mm-hmm.
money, turn it, make more money. Nothing wrong with that strategy. But I kind of learned from that. So the second piece, I was like, okay, I just went through that. I'm gonna keep these. I'm gonna keep these assets. Take advantage of the
Mm-hmm.
tax benefits that you get. Take advantage of the cash flow. And also, I didn't want to be transactional, and I didn't want to have to try to time the market.
Right.
And so, to your point, the whole goal always is to return the investor capital
Yeah.
with a profit. Some kind of preferred return. But that might be 3 years, it might be 5 years, it might be 6 years.
Right.
So there's no gun to your head with an exit.
Yeah.
Right.
But you know what you end up doing is you end up attracting the right investors.
Correct.
And psychologically they're on board for the long term, and they're also not calling every 3 weeks and saying, "Hey, have you sold it? Have you sold it? Have you
Right.
sold it?" And that's what I really appreciate. Now, a lot of people that are out there raising money, they have a hard time just selling the truth of what real estate should be, which is long term hold, stability, cash flow, mortgage pay down,
Yeah.
appreciation. Everybody wants to dress it up and
Yeah.
call it
Yeah. And a lot of
things.
people want that golden ring at the end, right? They
Yeah.
want the equity, right?
Right.
So we have almost $1 billion in equity
Right.
in our assets today. And if we sold, that would be taxable. It would be a big capital gain. Obviously it would be a big payday for everyone.
Yeah.
But I'd rather have the monthly reoccurring cash flow.
So knowing what you know now, if you were to give, 20 or 25-year-old Ken advice, what would you want to tell yourself? Like, what kind of advice would you give yourself?
Well, the first thing is I started probably like a lot of people. I started giving my money to a financial planner, a wealth
Right.
manager, or whatever, even
Yeah.
as part of my paycheck or whatever,
Yeah.
whatever it is, not really understanding, how the system works, right? So the way the system works is when you put money into a bank, or you put money into an insurance policy, or you put money into a pension, or you put money into a retirement plan or whatever, it's a problem for somebody,
Mm-hmm.
because if I'm handing you my money to manage, then you have to manage it. You have
Mm-hmm.
to invest it. So, you're basically transferring that responsibility to somebody else.
Yeah.
So I call it from Main Street to Wall Street, and that's the system. That's the system we're in. So I would tell that 25-year-old, if you understand the system is for you to put your money with someone else, so
Mm-hmm.
they can manage it, invest it for you.
Mm-hmm.
If you just figure that out, and take control of your own money.
I had it told to me another way. It says, when money meets experience, the experience gets the money.
Yeah,
And the money
it's
gets
true.
the experience.
I know. And so, I remember one of my first trips to New York. And I'm just a knucklehead that grew up in the Pacific Northwest and had never even been to New York. And so, go there, and it's super intimidating. You just realize that these are really, these were all the A students that,
Right.
are sitting around managing
Other
all
people's money.
that Main Street money.
Right.
And they're as hungry to find somebody like us as anyone.
Right.
So I came back. I was like, man, back then this was Lehman Brothers and some of those guys.
Right.
And I was like, these are smart, fun people just looking for that money's looking for a home. So if you just know that there's plenty of money in the system looking for, again, who pays what? Well, the property
Yeah.
pays. Everybody thinks it's people. It's not. It's the property. If you buy correctly and the property produces the money, then it flows all the way down to, that quarterly statement, hopefully, that people get.
Yeah. And ultimately, because you have and just a mindset perspective to see yourself as solving their problem, it just changes your frame. Because
Correct.
I've been in those New York meetings for
Yep.
big term sheets, and those, it's like they make those tables massive
Oh my
on purpose,
God,
right?
yeah.
Just so that there's 4 people meeting in a 40-person boardroom, and they do it on purpose because
I
it's
know.
the
Yeah.
posturing, right? It's the
hysterical,
positioning. So,
yeah.
but if you go in there with the mindset of, hey, I have a way to solve your problem,
Correct.
you're drastically changing.
That's right. And
Yeah.
that's how I see it. I'll be there in 2 weeks. Go back there. We got 6 or 8 meetings back to back because, I think we're heading into some distressed times, and, I'm going back there for equity,
Mhm.
not for debt.
Yeah.
That's a dime a dozen. You can get debt anywhere. But to go back and find a partner, maybe it's a family office, private equity, institutional equity, whatever.
Mhm.
Those folks have a problem. Here's a guy from Scottsdale flying out there
Is that right?
with hey, this is what I see. This is
Yeah.
what we want to do for you,
Yeah.
and hopefully we can cut some deals.
Yeah. Well, and having the experience and the team, and it's probably a really good segue, is I've noticed over the years, and I was telling you this before, is that when you guys used to buy properties, you'd buy them and just keep the name, whether it was Wicker Tree Apartments or
Yeah.
Saddle Creek or whatever it was. What was the thought process behind the rebrand and,
Yeah.
and when you did the places? Because I remember I was around for that and I saw that. And I was
Yeah.
just like, and then it clicked. And do you mind sharing that?
Sure. Yeah, of course. So I think with anything that you're doing.
Yeah.
You start off with 1, and then you got 2, and then you're at 3, and then you're at 4. And all of a sudden, you start to see a pattern,
Yeah.
and you're like, this is a great time to brand, right? I did it with, we have a book publishing company. We did it with that, actually, right behind you, the ABC series, right?
Right.
ABCs are property management.
Oh,
ABCs
fantastic
are
books.
so same thing.
Yeah.
Just something that somebody can grab onto,
Yeah.
and so I saw the same thing to do with the apartments is the place at, right? The place at Saddle Creek, the place at Sun City. It's just a branding, and then it just falls into the, you've got the same colors, the same fonts, and you start to build a brand. I never realized the power of a brand.
Right.
Actually, I learned through the books.
Yeah.
Because even Rich Dad Poor Dad, when Robert wrote it, it was a huge success, still is. Then the next one, then the next one, then the next one. Then I wrote a bunch, as you know, under that brand. When you look at it on a shelf, different fonts, different colors, different sizes, different this, it doesn't look like a brand.
Right.
Well, so there's at some point there's a rebrand where you're trying to, have some kind of consistency.
That's right, because the original version of the books, when you republished them, they all started to look.
Correct.
That's right.
Yeah, so it's the same.
Yeah.
So you start to see that with things as you start to scale it. It could be a franchise, it could be whatever. Educational system. It could be anything that people buy repeatedly. So there's some familiarity. It helps with the sales. And everybody kind of rallies around it a little bit better.
And I bet you have tenants that are moving from one market to another, and because they have such a good experience with you guys, they'll see if you guys have properties in Texas or other parts of Arizona or whatever it is.
Yeah, and then also it helps from a lender's perspective. It helps from vendor perspective.
Right.
With the logo and there's a whole bunch of things around branding that you have to learn as you're scaling a business. That the familiarity. Does breed, from market to market to market, and then people move around too, which is awesome, from job to job or whatever, and then they carry your brand.
Even your staff, that's
correct,
right, because they feel like if the spouse is moving, they can get a job with you, maybe at another site,
that's
across town or another part of the.
You got it. Yeah.
So, the knock-on effects are there's just even your standard operating procedures.
Correct, all of it.
So did you just one day go, okay, like brand tomorrow, or was it?
No, gosh, I didn't know how to do it. But I did recognize we needed it, right? You start to see things in a pattern. It's just, we need consistent colors and consistent branding, consistent logos, consistent uniforms, just everything kind of branded from the front door in. And then you start to develop systems and all those kinds of things. And then you find people that have been there before and to help you do that. So, you think about it, you carry it all the way through the website, all the way through the tour, to the models, from the leasing center to the bottled water, to everything. I'm sure, even when people are greeted at the front door, to the mats on the floor, the flags at the front, everything. So everything kind of happens that way, and then you start to have these familiarity. You start to breed familiarity within the industry. People start to realize that.
Well, and it creates confidence, and it creates whenever you go into a high-end retailer or whatever it is, you expect a certain type of experience or whatever it is.
Exactly. You go into a discount tire and they're all the same. You go into a Cold Stone Creamery, they're all the same, or a McDonald's or a Tim Hortons or whatever. It all is the same. And,
hey, Canadian reference.
Yeah, man. I gotta get you. Seriously, it's super important.
Yeah. Yeah, no, it creates just it's the brand loyalty. I mean, I use the analogy of a Fruit of the Loom T-shirt for $4 on Amazon, or a Supreme T-shirt for $1,000. That's nuts, right?
It is.
But that just shows you the extremes, because it's 100% cotton either way, right? So, and you guys have obviously created that experience. So, let's talk a little bit future paced here, because we're sitting here 2024, and on your podcast, it was the first time I heard the expression "stay alive till 25." And now looks like we've revised that forecast a little bit, with things moving out into 26, 27, or Where are you seeing the
I
market
actually
eventually?
still believe if you could stay alive to 25, I think 24 is the, the year of exposure.
Okay.
I think some people, will kick it into 25, but I don't believe interest rates are going to move significantly
Mm,
enough to really bail anybody out.
yeah.
So that train's left, right?
Yeah.
It's just not coming back. Now, it's very possible in the US at least that we're heading into a new election year.
Yeah.
We could see a little bit of relief here and there, but it's going to be political nonsense between here and November. Let's just be clear on that. It's going to be ridiculous. I don't even want to watch TV. It'll just be
It feels like
crazy.
reality TV.
It's unbelievable. I can only imagine what it's like for you guys.
Well, our election cycle is like 2 or 3 months.
Yeah.
And then we take a shot of maple syrup and we're good. That's
Yeah. That's funny.
obviously it's a little bit more than that. But our your like as Canadians, we watch your elections
gosh.
like reality TV.
By the way, I
because
just want to publicly apologize for our election process right now here to you. Yeah, so I do think you're gonna see a bunch of stuff, in the next 6-8 months.
Yeah.
For sure. And I do think the Fed's under a fair amount of pressure
Hmm.
to lower rates, but I don't know how significant that's going to be. The
Yeah.
majority of the U.S. is sitting under 4%, locked,
Yeah.
fixed, and we're in the sevens. Even if you say it's 5, it is. We're not moving 2% anywhere soon. So it's gonna, wherever we are. And so kind of the point is stay alive to 25. I think if you have the capital and you can negotiate with your lenders or whatever it is, and just keep some dry powder,
Yeah.
you're gonna be fine. Get through this year, and there 25 it'll still be going,
Hmm.
of course, but you're gonna have to work. You're gonna have to work on any problems that you have. You're gonna have to figure out in 24.
Yeah. We underwrote a lot of deals in 23 just to do. I think we did 1 or 2.
Good for you.
That's all. But
Actually, good for you.
but we bought one. It was 144 units, and it was the amount of deals we look. I've never worked so hard in my life.
Good for you. No,
But it was
shows discipline.
because your exit cap rates, brokers are trying to tell you, oh, it's a 4 on the exit.
I know.
Come on, man. So
I agree with you.
it's
We did the same thing.
yeah.
Yeah. We again, when you're not focused on the exit cap rate and you're
Yeah.
focused on paying the investor,
Yeah.
it all is pretty clear.
Oh yeah. Yeah.
You just pass.
Math is math. I mean, it
Correct.
is what it is, right? So when you look at that next 12, 24 months, I know you guys build, I know you
Mhm.
guys buy. Preference either way, or what do you think?
Yeah, it's a good question. Well, first of all, values are down 20 to 30%
Okay.
for sure because cap rates went up.
Yeah.
Let's say they went from 4 to 5. Let's say,
Yeah.
even though they're a little more than 5, that's 20% right there.
Yeah.
Just 4 to 5. So whatever you had is worth less. So you might be sitting at about the loan amount. So that's number one. I do think you're going to start to see more distress. You're going to say, well, there's 2 kinds of stress. There's stress and then de-stress,
Mhm. Yeah.
or distress, I should say. I think, we could see a little bit more pullback. At the same time, there's a fair amount of new construction that's hitting the market that got started a couple of years ago.
Yeah. Yeah. You were
And
mentioning
so I have a couple of those where we have 2 projects in construction right now. One in lease up, one's about ready to start lease up. So, but we started them years ago, a couple of years. This is when rates were low, right? So we're under construction on some, and so it was a lot. I think there were 450,000 units delivered in 23, and I think there's going to be over 600,000 in 24. And then there's going to be some more that'll trickle into 25. But after that, man, it drops off. So here's what I see. I see flat rents. I see concessions. I see a lot of product hitting the market in the U.S. specifically, all over in different markets. If you want to, that's easy to figure out.
Mm-hmm.
Just look to see what's under construction. And, so you're going to have this temporary window of a lot of units. And so the tenants are going to get relief, which is good. They deserve it.
Yeah.
For the next couple of years. which is going to drive these problems, the ones that already had issues with lenders, even further.
Oh, yeah.
It's going to be more problematic. So I think the next couple of years are a buying opportunity if you buy correctly. So just imagine this. If you buy a property that's, let's say, running high bad debt. I just looked at one today in Las Vegas. Okay, it's got 4.5% bad debt, which means that it's running at about $20,000 a month of non-collectible. I'm not talking about delinquent, by the way.
You
just
non-collectible. You're not
non-collectible.
gonna see.
It's like 250 units, I think. So like they're losing like 10 units a month. Okay, there's that. Then you've got another month free, let's say.
Yeah.
So you got that. So you've got bad debt, you've got loss to lease, and you've got concessions. And all said and done, this thing does about 82, 83% collected. Okay, that's today.
Okay.
This is Las Vegas. So, I mean, man, just once that market tightens up and all that new product stops and you can turn that management around and get better tenants in there, all that stuff.
Yeah.
Now you take what is literally about $500,000 to $600,000 in lost money, and if you can get that from, let's say, 83% to 91, 92%. That's a value add just from management and waiting for the market. So I think that's what I mean. You're buying on existing numbers in distressed markets with high problems, a high occupancy or low occupancies.
And all you're doing is restoring. So for those of you
Correct.
who are wondering, dollars and cents, I mean, $500,000 at a 5 cap is $25 million.
Correct.
And that's real money.
That's just one property.
Yeah, and that's just bringing it back, not speculating on the future. You're bringing it back.
How do we get it to 90% collected
Right.
from 82, 83?
Right. See, those are the best deals because you're not. When we talked at the beginning of the call, you're not waiting for the market to save you. You're creating your own situation where you can literally.
A property is not supposed to collect 82%.
Right.
Right. Beautiful project. I'm talking about attached garages, 2 and 3 bedroom units, like nice.
Huh.
These are not like projects that you would even imagine. They're just poorly managed in markets that are adding supply right now. So they're having to do that because the property is 15 years old. So they're having to do concessions to compete with the new stuff. This is just normal. So you buy it on today's numbers and you underwrite it correctly and then you wait.
Yeah. Well, so going from where you are today, so earlier, Ken, we were talking about, you started in the business, you built up to where you're at today, and you guys have bought and sold. I know you've turned like $4 billion in assets since you guys started, right?
Yeah.
You're at the $2 billion now. So I've heard you say in other podcasts is that you guys are going to be, the goal is to get to $8 billion.
Yeah.
So let's talk about that because you're 300 employees, 10,000 doors, $2 billion in assets. In your mind's eye, aside obviously from investors and things like that, but what do you think the company is going to have to look like in the next couple of years to get to that level? Or is it just more of the same?
Well, it's a good question. It's actually, I'm at the most fun stage.
Is that right?
Yeah, because I have the base set, right? I've got a great COO, great CEO, great CFO, great CIO. We have the equity. We have the debt relationship.
Yeah.
We have the property management company. We have the renovation company. We have the construction company. So to be able to have that base and then go into a new city like, let's say, Las Vegas.
Yeah.
And say, we want to buy 2,000 units.
Right.
Which we could do. Obviously, what was that? 6 or 8 projects, maybe?
Yeah.
You can do that in a couple of years, right?
Yeah.
And so all of a sudden, you start to see that that's what is that? That's maybe $500 million worth of assets, let's say, in one market, and then you put a regional there to manage them, and they just plug into the system.
So, the foundation that you're describing today, like I just want to make sure everybody understands the foundation that you've laid today. When did you know that it was ready for what you're doing now? Like, what was there like a clicking moment where you're like, okay, like we got this. We can go 2 to 10.
Well, we didn't like you 2 years ago. I didn't want to buy.
Right.
I mean, you imagine the hardest thing to do is to not buy.
Oh.
because again, I have what 4,000 investors that want me to buy.
Right. And they want to give you
They
money.
want to give me money,
Right.
and I'm like, nope. I'm sorry. What we're seeing is the same. I don't want to rinse and repeat everything you just said, but we went through the exact same thought process. We're not buying.
We were so at the height of the mania, literally 2 years ago to this month, we were what the broker told us we were best and final on like 250 doors in Jacksonville. I love Jacksonville. I wish I could have got in sooner, but and I said, so how many people are in the best and final? He goes, 12.
Yeah.
I'm like, dude, this isn't Storage Wars, man. Like, what do you mean 12 people in a best? But that's how crazy it got, right?
Trust me.
So
right, you could fog a mirror and be in best and final. I think I was. So anyway, so the point is, there's a time to grow.
Yeah.
There's a time to maintain.
Yeah.
And that's what we've been doing. I've been focusing on operations and stabilization, overhead, renegotiating every single thing I could.
Got it.
Utilities, insurance, and property taxes, and and vendor contracts, and everything we could just to tighten up our systems. Because when you're growing, those get loose.
Yeah.
And then so we've just done all that. So that's done. And so I was waiting for the market to tell me, just tap on the shoulder, say, okay, I'm ready. So like anything, you got to strike when the iron's hot. You got to go after it. So that's our goal. We will definitely do it. I don't know how quickly, because that window could shut again after a couple of years.
How do you mean?
Well, you just never know. Like, things happen. Like,
right.
I would have guessed that we would have been buying the last 2 years.
Oh, right. Because you don't know what the government might do with bailouts.
You just
or
never know, right?
There's too many.
There's
things.
just all these factors, and so again, you got to bring it all back to the asset.
Right.
Does the asset pay the investor back? If it doesn't, then we put the brakes on. So, but now I believe we can buy, like the property I just in Vegas I was just telling you about. We're in best and final on it, and everybody's looked at it. I haven't seen it yet, but a bunch of people in our company have flown over and visited it and all that. And so I think if we can buy something like that and in the low 80s collected wise, and then grow it, everyone wins. And then just hold it long term. So if a market's in that state, you should buy as much as you can.
Yeah.
And so that's the thing. But then the window can close, right? Interest rates could go up. There's just so many things that could happen. Yeah. Las Vegas could pass some kind of, rent control law, or, you just never know. Like, there's these things that jump up, and then you go, okay, so now I'm going to go to Salt Lake, or, you just bounce around. Just go to different markets. And so that would be kind of what we're going to do next.
Do you mind me asking you about your strategy, how you first got into the Texas market?
Yeah.
And how you went through the back door, or the back. I think it was a very clever way of doing it, because you're telling me about it. I'm just like, that is brilliant. Like, just, do you want to
bought the management company?
Yeah.
I know. Like, well,
you're like, I know that was good.
I didn't realize it. Now I look back and I just smile, but yep, we went in, we bought a 9,000 unit management company,
right?
And of course, I have a management company, so I understand
how
they should run.
Yeah,
and this one was horribly run, but had a whole bunch of properties. It was managing 9,000 units. So when I bought it, I broke the management contracts into 3 categories: red, yellow, green. So the red were the owners I was going to fire in the first 30 days. The yellows, I was going to write them all letters and say, you need to capitalize these projects better or whatever, and then they keep the greens. So I bought it, but I ended up keeping, like, I don't know, 3,000 or 4,000 units or so. I basically fired
you fired a whole bunch of the
almost half, yeah. It was for various reasons.
Right. But why did you want the property management company?
For the information. I wanted the data. I wanted the income and expense data. I wanted people.
Makes sense.
Yeah, they had some. We got some great folks that way.
Oh yeah.
Yeah, like really good on-site managers, really good regional managers, and really good vendor relationships. Imagine if you go and just put your name on a door in Dallas and buy one project. You imagine it's like pushing a rock uphill. You don't know anybody there.
Anybody I talk to in the 9 or 10 figure or 11 figure space in their business or personal life, they always say the same thing. At a certain point, you're literally just you're collapsing timeframes and you're buying the people,
Yep.
the
That's it.
infrastructure, the
Yep.
people, because building it from scratch, like, what you've built today, you don't have another 30 years to do it again. So why
Correct.
not buy it?
Right.
And then,
I'd rather buy it, strip it down, keep the
right.
best assets, people, clients, cash flow, get rid of the rest fast,
Yeah.
and then, that's what we did. That's how we got there.
Yeah. Let's talk about another really cool thing that you introduced a few years ago. You've got your own conference now.
Yeah.
Can we talk a little bit about that,
Of course.
if you don't mind?
Yeah. I'll tell you what happened was,
Sure.
well, I stole this from Warren Buffett. Warren Buffett does that annual shareholder meeting.
Yes.
It's pretty cool. I've been invited a bunch. And so, it's basically lift up the kimono.
Right.
Here's what we got going.
Yeah.
Here's the good, the bad, the ugly. Here's what I see. So I started doing that. I was like, it's a good idea. I'm going to do that with my investors. So for years we were doing that. I was funding the whole thing. They would fly into Scottsdale and they would show up, hundreds of people. And I would have my whole team there, like the managers and we would bring vendors there, and because the investors, they just want to look at the person. I've invested with this
involved,
project. Tell me about it, right? And they're talking to the real person that's managing the building. So it was great. Okay, then COVID hit, right?
Right.
And I was like, oh man! All of a sudden, we tried to do it online. Here in the studio here. That was part of the reason why we built this studio. And that was a failure because nobody showed up. I mean, they did, did, but it's tough, right? I had like my CFO. We had a whole thing here. And we were filming it, and people, they were chatting in. It was fine. It was actually fine, but it was just. We could have done it not live. We could have just filmed it and then pushed it out, but it wasn't the same. That connection of being able to share a glass of wine or a pint or with somebody. I was missing that. So long story short, also some of our investors were concerned about flying and COVID and all that.
Right.
So we went for a couple of years without being able to connect, right?
Mm-hmm.
As did everyone. So it wasn't new to anybody. It's just, and so then I said, well, then we took a poll and said, what do you guys want? Our investors, what do you want? Well, because what they would do is they would come here and they would want to know more stuff. They would want to meet more people. So I said, I'm going to put together a conference. And so it started with my investors in mind.
How did you come up with the name?
I didn't want it to be a real estate conference because of the feedback I got from them. They invest in gold and silver. They invest in stocks and bonds, and they invest in oil and gas. They invest in those things. I mean, just like you do, I do. Yeah. They invest in tech. Yeah. They invest in crypto. They invest in all that stuff.
Hence the name Limitless.
So So I was like, man, it's a financial freedom expo. That's really what people are trying to be. It's not all about real estate. So I was like, okay. So the number one rule is you can't sell from stage. That's the number one rule. And then so we hand select the people. So. Like if I like we got this guy out of Dallas that speaks on oil and gas, and I'm like, Mike, I'll pull you off stage. Your job is to tell them how if they're investing with somebody, how they can lose money.
Right.
Your job is to tell them the risks.
Yes.
Not to sit there and sell them on oil and gas.
Right.
So so we just made it all about that. And
that's on brand for you too.
It's a huge
books and everything. It was
huge. It was huge, and I didn't realize how big it was.
Yeah.
Now we do have another room where you can put a booth up,
right? And
they can go sell away. But in the conference space, it's sacred, and there's no sales. So that was year one. We had 1,500 people. I was like, I wonder how much money I'm going to lose. I swear to you, I'd never done a conference. I did it with my friend Tarl, who is in the conference business and really understands it. So I was relying on him mostly and his team.
Right.
And he's educated me beyond belief on how to put these things together. But I really was prepared to write a check. And the first year, we made a little bit. We broke even. I was happy. And we put a really good conference on. We learned a lot. And we said, okay, let's get it a little bigger. We did it again. So it's limitlessexpo.com.
Okay.
And this year it's in Dallas on the 29th of August for a few days, 29th, 30th, 31st. And it's 40, 50 speakers.
Amazing.
Yeah, all just people that I really am like, I'm trying to keep my ear to the ground. Like, what do people want?
Mm-hmm.
Last year we brought in the market maker for the Fed.
Oh.
And Joseph Wang, they call him the Fed guy. And he was one of our kickoffs. And so I was like, oh, what's the Fed going to do?
Yeah. Everyone wants to know.
Right.
Yeah,
right. So like all of that stuff.
Yeah.
Right? And then, we had some lenders and talking about the markets and interest rates. And we had different folks talking about different things. They're trying for social media, personal branding, you name it. Like everything that's on everyone's mind. Right.
Yeah. Well, and what I appreciate about, like, when I look at your speakers, you're not inviting hype men or people that are just all hype. You're like, you look at the bios of anybody that's speaking on your stage, like these are people that have women that have done things.
Correct.
And we're kind of laughing because there's a lot of people on social media that are fantastic at playing the social media game. But I really do appreciate that. And what's really cool from your perspective is you're right, because you're investors, because some people would have the mentality, well, why would I expose my investors to all this other stuff? I mean, look,
they're already doing it.
They're doing it.
Like,
doing it
I'm
anyway,
doing
right?
it. I don't want to be all in real estate.
Yeah.
Like you should. Diversification is the key.
Yeah.
So you got to be careful.
Yeah. So obviously you're gonna have Robert there.
Yeah, Wild Man Robert. Yeah, he's big on Bitcoin and gold and silver right now.
I just love watching him in interviews. I swear it's like he says the things he says, like he means it, but he says it in such a firm way that you can see the people I've never interviewed him before. They're just like they're like, yeah, so right.
I know. That guy is the smartest. He's the smartest, man. Like he's always reading 15 or 20 books at once. He sends a video to me every week. We study it and we jump on every Thursday morning and we study a video. Like it could be an hour video with a group of us, and he's constantly pouring himself into stuff. I just people don't understand him. He's well intended. I mean that sincerely. He's been a gift for me. He's I would have never been a teacher. I would have never been in this position without the Rich Dad. Him and Kim.
And I remember the story. You met him when you had a deal.
I did.
I remember him telling the story at one of the conferences where he said that he met you and he was impressed because you didn't just show up; you showed up with the deal.
Yeah.
To the first meeting.
Yeah, of course. I mean,
of
course.
I got a deal, right?
Yeah. I think yes. I mean, again, like at the time, the Rich Dad Poor Dad was new. It had just been released. It wasn't the. You could look back now and go, "Wow,
that's so obvious." But back
yeah,
then
but it wasn't obvious. It was just a guy with a book.
Yeah.
And for me, I was in EO at the time, Entrepreneurs Organization. I'm in YPO now, but it was a guy introduced me to him, and it was another LP. Him and Kim were just one more LP. They were just somebody that might invest into a project.
Is that right?
And as was for me, that was a normal lunch. Meeting with somebody, I had a deal in Tucson actually, and I'm like,
no kidding.
Just trying to raise money.
And then I remember Kim saying that after they realized you were fantastic, that they were just like, here, manage all this stuff too, right? Just all this other stuff. And
Yeah, that's true too. They did. They had a bunch of, they owned a bunch of stuff, of course, but they were having challenges on the management side.
And that's the number one issue people have with real estate. It's so easy to get into something, but it's so hard to actually run it if you don't know what you're doing.
Yeah, I'll tell you just a fast story. I mean, what happens is we buy things, we turn them over to somebody, then we trust them, and then we go on and do the next thing.
Right.
Well, they did that, and this one of the buildings, Kim's like, hey, can you go check on this project for me? And we didn't even manage it. So I was like, yeah, happy to do it. I went over there. This woman, beautiful woman, was managing it. She was, I don't know, in her 60s or 70s, and she was so nice. Just a beautiful soul. But her son was stealing from him.
Oh.
He's using the company credit cards. And so I walked into a vacant unit. It was full of all the stereo equipment, also still in boxes. Like I was like, I mean, not just a few things of, blowers and like generators and like big ticket stuff, $4,000-$5,000 thing, $400,000-$500,000 things, the whole unit full. And I remember I called Kim back. I'm like, hey, I'm sorry to tell you this, but you got an amazing woman over there that obviously has a not so nice son. I don't know if she's turning her head, but whatever, you better go check it out. And sure enough, so those things happen. And, and the point of the story is you have to, you have to, as an owner, you have to stay close. You have to watch, you have to manage. You can't just, it's not a stock.
No. One of my partners says all the time, keep your eyes on your assets.
Yes, that's right. Yeah,
ultimately,
right.
No one's going to care. And I mean, in any other business, if you have call it a $10 million operating business, you would never think it's okay to give somebody the keys to your business for 50 grand a year as a salary.
Correct.
Or 100 grand a year as a salary. Yet in real estate, people think that that's normal.
They do it. Yeah.
And they do it all the time.
Right. And so even in my own firm, as my buddy says, he's in the water business, no pressure, no flow, right? I'm like, that's a pretty good one. I always just keep a little bit of pressure. We get the weekly reports. Yeah. I'm sending emails to my properties. They see it's from me. I'm flying out there. I'm meeting with them. They know I'm coming. It's just a little bit of tension in the right way.
Right.
It's part of the process.
Wow. Ken, this has been fantastic. I'm looking forward to the conference you guys got going on this year. I'll be there. It's going to be fantastic. I'll bring a contingent of Canadians with me, and
I look forward to it. Yeah.
We honestly we love U.S. multifamily. We love the marketplace here.
Well, I'm going to do a tour of one of my buildings. We're doing it in Dallas. I've got a bunch of projects in Dallas. Yeah.
Count me in.
Let's go check it out.
Yeah. Sounds good. Well, thank you very much. So we'll have the show notes with the conference, the promo code, all the different things, just to get everybody set up.
Happy to do that. I'll get you all set up with Jerry on that.
Amazing.
Yeah.
Thanks, man.
You bet. Thank you.